Hi, hello everyone. So let's start discussion on very important topic that is a project finance. And you heard about that what is a project finance, how it works, why we need a project finance. So where in this topic we are going to discuss what is a project finance, why we need project finance, and how the project finance is important for the infrastructure project. So where we are going to discuss funding, managing large scale infrastructure project and how it will work. So, guys, first let's discuss on the foundation of the project finance. So, where we discuss on the definition, core purpose of the project finance, and key characteristic of the structure, how it will look like. So, guys, let's first discuss on the definition of project purpose and the project finance. So, where we are going to discuss on the special purpose vehicle topic, non-recourse financing, risk allocation and contract, and the economic development role. So, the special purpose vehicle is a legally independent entity created to isolate the project risks and manage the project operation. So, basically, the sponsor and the EPC contractor, engineer, procurement and construction contractor, operation and maintenance contractor, or the authority like a national, if the road project in India, so the national highway authority of India, or the debt bank like NAFAD, or the NIL bank. So they will create the legal entity where they pool funds from the public resources, and that entity they will call as a special purpose vehicle. So that has a purpose to fund the that project, and it is in the non-recourse financing. So non-recourse financing basically means the lender, if the default will happen, so that transaction will not occur in the balance sheet, and that not affect the lender's borrower's side. It will be the asset that purchase for to pursuing that the infrastructure project. So non-recourse loan ensure the lender are repaid only from project revenue, not a sponsor asset. So understand, there is once the fraudulent will happen, and the a borrower will not able to pay the amount, so that will go into the supply act kind of thing. So the recover will done from the project revenue and the project thing, not from the sponsor asset. So we are not going to touch the sponsor asset. So and it is in the risk allocation and the contract. So project finance involve a detailed risk analysis and contractual arrangement among the specialized entities. So where the project finance involve risk analysis, contractual agreement. So what are their different kinds of agreement will happen, understand each agreement, how they maintain their ratios, debt service coverage ratio, or the loan life coverage ratio, LLCR. So that understand, and the economic development rule. So project finance enable the infrastructure growth without overburdening the public budget and corporate balance sheet. So they collect the funds from the in the purpose of the special purpose vehicle and the non-recourse financing. So let's move on the next slide, which is and the most important slide, guys, where we are discuss on the uh, key characteristics of the project finance and its structure. So where we are going to discuss on the high debt equity ratio, limited not resource financing and contract agreement, and the risk allocation and mitigation. So project finance exhibit a several defining character that makes it distinct from traditional corporate financing. One of the core feature is high debt to equity ratio, often ranging from 7 to 30 to 90 to 10, which allow the sponsor to leverage their investment while transferring substantial a portion of the risk. Lender, this is possible because lender base their credit evaluation primarily on project cash flow and supported by financial model including sensitivity analysis, stress testing, debt service coverage ratio assessment. And another important characteristic is limited non-recourse financing, whereby lender have claim only on project asset and revenue stream, not on broader financial standing of operation and structure demand. So contractual arrangements such as engineering, procurement, construction contract and fixed price and the fixed timeline guarantee supply will happen agreement, and the operation and maintenance contract of further characteristics involve and detailed allocation of the risks among the stakeholders. So that thing will cover in the key characteristics of the project finance structure. So let's move on the next slide where we are going to discuss and the stakeholder and the risk allocation. So the risk category and the allocation strategies of each kind of roles, that thing we are going to discuss on the risk types such as uh, uh, the the constant construction risks, operation risks, market and revenue risks, and the financial and the political risks, and environmental and social risks. So the risk allocation is define a characteristics of project finance and a crucial determinant of project success. Construction risks represent uncertainty and related to delay in cost overrun, technical failure during the building phase. This risk is commonly transferred to EPC contractor through turnkey contract that include performance guarantee, penalty clauses, ratio operation and arising the project become the including the factors equipment. So these are the things that we are going to cover in the project finance. So also the market and revenue risk. So market risks involve demand fluctuation and price volatility, mitigate the long term contract revenue. So how the impact of that contract on the market risks or the the project going or the project finance. So financial and political risks, if there is a change in the political, so terms and condition of the payments or the cash flow will get impact on the project finance. So financial convert the interest and currency changes. Political risks include the policy shift and manage the hedging and insurance tool. Then the environmental and the social risks. So environmental and social risks require the compliance with environmental, social, and governance standard and framework like the quarter principle and the sustainability growth of that the country. Then the benefit and application of project finance. So where we are going to discuss what are the benefits and what are the applications we are getting from the project finance. So the op balance sheet financing, it is and the most important advantage of project finance. So project finance allow the sponsor to develop large project without impacting the corporate credit rating and leverage by insolvency and the project the special purpose vehicle. Efficient risk sharing. So risks including the construction, operational, financial, and political are allocated to specialized parties to enhance the project resilience. So high leverage and the return. So high leverage structure amplify equity return while lender benefit from the predictable contract and back in the stream. So economical and development sustainability. So project finance support the infrastructure development, economic growth, and enforce the environmental and social standard of that country. Let's discuss on the common application and the industry examples of the project finance. So first one is the energy sector project. So energy project include the power plant, renewable energy with stable long-term revenue via power purchase agreement between the government authority and the private partner who develop the projects. Transportation and the infrastructure. Transportation issue the project finance for highway, airport, metros, bridges through concession model for the triple public private partnership agreement they will make in the transportation infrastructure to do the smooth businessing. Then oil and gas mining project really on long contract and resource right to reduce the project finance. And telecom and the water utilities. So telecom, communication, water management project are used in finance model due to predictability and the available resource team used by the project finance. So these are the end of the important topic which is the project finance. Thank you so much guys for attending this interesting video. If you like or if you want to build a career in the infrastructure finance, so please do and like, subscribe my channel, so that will motivate me to create more videos, such videos guys. Once again, thank you so much guys.